Now, the type of entity we choose is not necessarily based on liability, although liability is an issue. All the entities we're going to discuss do protect you from liability, but the real issue is one of taxes, because there's different types of income in real estate depending on the type of activity you're doing and who you're doing it with and what state you're doing it and so forth. So let's get into it. There are basically different types of income in two categories in real estate. So we have what's called active, or also known as earned, also known as ordinary income. And then we have the passive, which is things like rentals and interest income. So if you take a note or you lend money in real estate and you get interest payments, that's passive. So earned, active, or ordinary is going to be things like flips and wholesales. So if you buy a property and immediately flip it, that is going to be more business type, ordinary, active, earned income. Wholesaling fees, definitely in the same category. But if you keep properties and you rent them out for a while, you're going to get rental income, or if you sell it, you're going to get a capital gain. That's also in this category. And if you take back a note as part of the sales price, you're going to get interest payments, and that's also in the passive category. So what we want to do with corporate entities in real estate is separate out the active, earned, ordinary income from the passive type income that is different in nature because they are taxed differently under the Internal Revenue Code. So ergo, we're going to have probably more than one entity if you're doing both categories of real estate activity. If you're starting out and doing things like wholesales and flips, you're going to want to use a corporation. Now, corporation falls into two basic categories. We have what's called a C corporation and we have an S corp. Now, there's a lot of differences tax-wise, but let me kind of boil it down to the bottom line. If you're just starting out and you're spending most of the income that you're making, or even creating a loss, which in the first year is possible because you have a lot of expenses, you're going to start out with an S corporation. And when you start making more money that you can spend, or you have another job or another income source or another business where you have plenty of income there, and whatever you want to make here in real estate flipping or wholesaling, you don't want to spend that, then you may go with immediately a C corp, but most people start out with the S corp to begin with. Now, when I say corporation, that's a corporation like, for example, we might name it ABC Investments Inc. Inc. That's a corporation. An LLC is a different animal, limited liability company. So that would be ABC Investments LLC. What's the difference? It's mainly a tax difference, because corporations are C or S and they file returns accordingly. An LLC doesn't have a tax return. There's no such tax return that the IRS ever invented. So there's different ways an LLC can be taxed. One way is if it has one member, we call that an SMLLC, which is single member LLC. That means it has one owner or one member. We call owners of an LLC members, owners of a corporation shareholders, but same basic difference. So if you have one member, it's typically what's called disregarded. What does that mean? Well, that means the LLC doesn't file a return. The individual member, if that's you as a person, would be filing the income and expenses on your personal return. And if it's ordinary income like wholesales and flips, it's Schedule C, which is a self-employed business. Now the problem with that is highly audited return. You're going to be paying self-employment tax on your earnings. Kind of hard to bury expenses on there because it's all over your return. Generally not a recommended way to go. Another way we can go is to have it taxed as a corporation, either C or S. And in most cases, again, if you're starting out, you're probably going to go with an LLC taxed as an S corporation. Now, the last way an LLC can be taxed is a partnership. And as you may have imagined, a partnership requires at least two people. So if you're husband and wife, or you and your friend, or you and your cousin, you can go as a partnership. And typically we reserve the LLC as a partnership for the purposes of rental or passive income. So generally, if we want to boil it all down, we're going to go with an S corporation format for the flipping and wholesaling, and then a partnership LLC for the passive income like the rental. So you probably have two different companies. Now, which one should we do? Should we do a regular S corporation, an Inc., or do we do an LLC taxed as an S corporation? Generally speaking, I recommend the LLC as S corp because it doesn't require annual minutes and bylaws and meetings like a corporation does. The exception to that rule is in that in some states, the tax structure and the filing structure is much cheaper. For example, in the state of New York, if you file a corporation, it's significantly cheaper than an LLC because in New York State, an LLC is required to publish a notice in the newspaper. Can you imagine how expensive that is? It could be upwards of $800,000 just to do that publication. An S corp is infinitely cheaper in a state like that. And a few other exceptions. In some states, S corporations are just cheaper than LLCs because of the way that the state either taxes it or charges the fees for filing. But for the most part, most of you will go with an LLC tax as an S corp for your flipping wholesaling business. And then at some point, you may start up with an LLC as a partnership for your rentals and have two different entities. Now, here's the thing. What if you're a single person? What if you don't have a partner and you want to do rental properties? So if we have an LLC and one member is you, who's going to be the other member to make a partnership? Well, a couple of options. If you're married, your spouse, or if you have a good friend or relative, you can always make them a small percentage. So you would be, let's say, 99% and they would be 1%. Or if you don't want to do that, what could you do as a partner? Could you take that other entity that you've been using for wholesaling, that S Corp or LLC as S Corp, and put it right there as your partner? Can you be partners with your own company? Sure you can, because remember, a corp, or I'll put in parentheses, LLC filing as corp, is a separate legal entity with a separate tax ID number with a separate tax return. So the partners could be you individually, 99%, and then your S Corp or LLC filing as an S Corp as its partners, and now you have an LLC, and this would be for your rentals. And this would file a partnership return. All right, so in terms of tax reporting, you have your individual return. You have your S corporation or C corporation, more likely an S corporation for your wholesaling. That files a separate return. And then your LLC as partnership for your rentals would be a third return. So there is a little more, reporting involved and a little more expense to pay a CPA, but infinitely better for you to save taxes, to protect you from liability, give you a professional front to deal with the public. Highly recommended. If you have any questions, just drop me an email, bill@broncheck.com, and I'd be happy to help you get this all started. Good luck.